Longtime fans of the show should be familiar with the lender formerly known as Sue Pullen, and I'm pleased to announce that she's back, fresh off a rebrand and ready to help as Sue Mackey. Sue is a certified mortgage advisor at Fairway Independent Mortgage, an equal housing lender who focuses on finding the right product for you and your needs. She has over 20 years of experience helping thousands of homeowners. Whether it's purchasing, refinancing, or even a reverse mortgage, Sue will help. Sue's licensed in 36 states now, so reach out and let Sue Mackey it happen for you. The best way to reach her is just give her a call at 520-977-7904 or in an email, spullen@fairwaymc.com. Fairway Independent Mortgage has an MLS number of 2289. Sue Mackey has an MLS number of 206048. That email again, spullen@fairwaymc.com, and that phone number is 520-977-7904. Shoot Sue an email and let her know she needs to update that address. Disclaimer time. This is where I tell everyone to lighten up. It's just a podcast. Trading is like that roller coaster at the amusement park. Thrilling, unpredictable, and potentially stomach-churning. What works for one person might leave another clutching their hat in the wind. Our hosts and guests, they're awesome, knowledgeable, full of insights, but we're not financial advisors. So don't rush to make any investment decisions based solely on our banter. Always consult with a professional or do your own research. Plus, let's face it, we like to have fun, laugh, enjoy the trading ride together. It's all in the name of good podcasting fun. So remember, take it easy, don't bet the farm, and keep your seatbelts on at all times. Thank you for listening. Alright, hello everybody, and welcome to episode 3 of our ongoing mini-series, Informal Economics for Traders. Eric Mason, the informal economist himself, is our instructor, and joining me in the classroom is Vanta Trading's Mr. Banks. How you guys doing today?
Good, how are you?
Dude, doing good, guy. How you doing?
Not too bad. Eric, I heard you got sent to an early retirement board.
I got put out to pasture a little earlier.
Congratulations.
No, thank you. I appreciate it.
Let's see. Last month, we spent the majority of our time looking at the world of fiscal and monetary policy and how they impact the financial markets. Make sure we have links for the previous episodes in the show notes in case anybody needs to catch up. But tonight, we'll be diving into labor economics, employment trends, wage analysis, and their impact on the market sectors. But before we kick things off, if anybody has any questions, comments, or just wants to share something with us, feel free to send us a message either by Discord or email at bandoftraderspodcast@gmail.com or any of our socials. Now that we've got that housekeeping stuff out of the way, let's check in with the professor and see if we got any questions from last time.
Yeah, well, first off, well, thanks for the nice introduction, Kyle.
You're welcome.
Reminding people that I'm getting old and now in a retirement board.
Hey, at least I didn't ask you about your daily drug use.
Insulin for anybody who's listening. So we got a few. My personal favorite was, I don't want to put out the person's name, but whoever emailed me what it was clearly a question from your homework, because like you left on the 2.2.
Oh, I thought he had a multi-part question, and then you just deigned that those were not worth answering.
Oh, no, that would be a way better viewpoint. I wish I did that now, Kyle. Oh, that'd be so much cooler. No, this is like clearly, as somebody who has taught college courses, I clearly know you copied this out of Canvas or eCampus or Blackboard or any of those.
Could I read it?
Read it up.
2.2. How might the price elasticity of demand for consumer electronics influence the strategies of manufacturers in the market?
Just what is that? Why did you send me your homework, man? Like, I get a fair share of people emailing me their homework, which is whatever. I wouldn't do the same thing because I love economics. It's the best field. Just do your homework, man. It's a blast. It's going to help you in life. It's the 5th highest paying degree. Get into it. Enjoy it. Embrace it.
Is it really?
Yeah, econ's usually like the only degree that's not an engineering degree that's in the top 10. Nursing is usually pretty good up there.
Is it one of those degrees where you actually can like do stuff besides teach other economists and continue the useless cycle?
Useless cycle. Oh, I was going to take a shot at a different field there, but I'm going to be polite.
Like anthropology?
Oh, dude, I'd love to be an anthropologist. That'd be fun. I don't know how much production you add to the economy, but the BS in econ is usually the profitable, and the BA has its difficulties. You got to learn math.
Right.
Math is it's all about math. I was just really impressed by that. Just sending that over, I was like, God, love that dude. I hope
ballsy. Should we give him something at least, like a book he should check out or something like that?
Yeah, so I actually got this question a while ago, so his homework's already due. So I'm happy to give the 15-second clip note answer.
There you go. All right.
So I apologize to any professor who's listening to this, who I'm inadvertently helping their student.
It's probably yours.
Yeah, I mean, so the key question here is the type of good here. Elasticity of demand, or basically how does demand change relative to a change of price? That's what elasticity of demand is. Um, it depends on the product. So, like, we were talking about drug use earlier. We are talking about insulin. So, like, no matter how much you jack up the price for insulin, you're going to get a pretty fixed amount of consumption. So, we call that type of demand inelastic. It tends to be perpendicular to the y-axis.
Hmm.
So, no matter the price, the people who need insulin will do it. Will take it. The flip side of it, no matter how much you reduce the price of insulin, you're not going to have more people consuming it. It's not a normal good, as we call it, where
Right.
consumption increases with the decline of price. So for consumer electronics are usually considered a fairly inelastic good. So it means it's more price sensitive,
Right.
and we could look at that. We can wrap it into trading. So if we look at that from a purely market standpoint of just saying like, hey, if you decrease price, you should it's a normal good. If you decrease price, you should see an increase in consumption. Therefore, uh, for lack of just to keep it straight to what I think this is probably like an econ 202 question or 201 question. Um, so what you basically see is as you drop that price down, the quantity demanded by the market will have a pretty pronounced right shift and increase. But yeah, I mean that's the short answer. From a strategy standpoint, this is why we see companies like Apple really focus on investment in markets that have lower medium household incomes than say the U.S. Why you see the expansion of the Indian market for Apple and other Southeast nations, while they have much lower income, just the where they start on the demand curve means they are in a they're in a position where as they adjust price they can gain more ground, so the price is more elastic relative to the point of demand. So like if something sells in the market for $10 and the current market price is say 8, they can increase that price and still have more net revenue,
Mm.
even though they may lose some individual units supplied. So that's where like consumer electronics, that's also why in India you see pretty pronounced price discrimination compared to the United States, where you'll see a tablet sell for a sixth or an eighth of the price. So whenever you see like a company that deals in consumer electronics trying to expand into a market, one of the best ways to test if that's going to be successful is start looking at disposable income relative to how much of what the price is. One of the best indicators for this, if some investors are looking for markets, especially what's happening right now in like sub-Saharan Africa, where we're seeing some market expansion
Hmm.
in consumer electronics. Look at use of cell phone rate by country. Look at things like wireless internet access. Those will tell you, how stiff the market is, or in other cases, how open the market is for that introduction of new supply coming in there. And new supply changes price. Price is affected by elasticity. So there is actually a little bit of trading. This
Right.
kid was not asking me based on that. I don't want to give this kid too much credit.
No, I was just pulled it up on ChatGPT just to check because you can do that too. I mean, we love the engagement and all. If you got more
Yeah.
homework questions, please send them our way. We'll not answer
Please
them.
do.
I did have a question for you just about the debt ceiling, since we talked about national debt last week. Um, Biden, when he announced the debt limit deal, the raising the debt ceiling, that they avoided he called it a catastrophic default that they avoided. Like, my question is like, don't we own our own debt? Like, who are we defaulting to?
Yeah. No, Kyle, you're 100% right. The American citizens own the most debt, followed by Japan and then China.
Hmm.
So U.S. citizens own about 20 to 23% of debt. Japan owns about 20%. China's like about 18%. So between those three parties, you're talking about 60% of debt. You're talking about about 62 cents on the dollar of national debt. So yeah, I mean, it would be a default. Default would absolutely be catastrophic because I know I talk about him too much, but Niall Ferguson describes currency as trust inscribed. So it's debt is the same way. I mean, if you're borrowing in dollars and your dollars are not the system that holds that dollars is not able to properly service its debt,
Hmm.
yeah, it's catastrophic. On a much micro level of this, so every time the city of Quincy sells bonds, I have to sit on a due diligence call,
Hmm.
and I sit on that with attorneys who both my attorneys, like my bond counsel we call it, and then there's attorneys who are writing the POS, and they ask me 60 plus questions. Except when we did the pension obligation bond, they asked me about 118 questions. Took about 3.5 hours to get through, and they will ask you multiple times through their phrase differently. my opinion as the chief financial officer on the city's ability to service both short and long term debt.
Mhm.
And it's funny, one of the last questions I ask you is always, what keeps you up at night? And I'm always like, the inability to make a debt payment. Once you default, you're shut out for the market.
Mhm.
There's, you just are. And if the U.S. defaults on their debt, it's catastrophic because so much of the Fisher equation, so much of the baseline assumptions to how we construct interest rates are relied upon the risk-free rate, which is effectively the shortest term treasury you can have.
Mhm.
So any confidence in there, any lost confidence in there, will restructure all interest rates across the economy. There is no more baseline. You're removing the foundation. Yeah, it's a scary
Okay.
prospect. The U.S. should never get to that point.
It seems like we're almost always at that point. Like once a year, it seems like these days.
Yeah, I mean, it's Janet Yellen. Like this is where like the Federal Reserve and the Treasury are just really interesting. So like Janet Yellen, who probably understands the dynamics between the Federal Reserve and the U.S. Treasury more than any human being on Earth. Uh, it becomes really interesting because last year when we were facing this, we were supposed to hit the debt ceiling in, I think we were supposed to hit it like early June, but Janet Yellen was able to move accounts and basically get us until mid July.
I remember that.
Yeah, and that's true about the fungibility of public dollars on keeping the ship running,
Mhm.
and it's a bad indicator to the market when we can't get politically aligned to handle the debt service,
Right.
to handle the debt service, and that's frustrating because
That's the job. Like
right,
pay the bills. That's what you're there for.
if you're not trying to pass a balanced budget, you've accepted you need debt. Like,
Right.
yeah, it's very, but it's a bad indicator to the market. I personally don't think the U.S. government will ever default because,
It seems like it would be like if you erode the faith of the dollar, it seems like that would be the end of the dollar's dominance.
yeah, the U.S. dollar has gained dominancy over the last 20 years. We were at about 70% of of uh, of transactions, and now I think we're up at like 87%.
What?
Uh,
But I thought bricks.
Bricks, fuckers, dude. They gotta get. They just keep adding countries that just can't agree with borders. It's just the weirdest. Let's add these two countries, and one of them wants to blow up the other one's dam. That would be good for geopolitics. It's fine. Be a strong currency. Yay!
All
5 of our countries are sanctioned.
Do we have any other questions that were submitted that we want to touch on here?
So I dropped one in the chat. This is I got from somebody named Jesse, and it was, how do recent shifts in government fiscal policies, including changes in taxation and public spending, directly impact investor sentiments and market volatility? And my favorite part of this question, dot to dot, your view. I'm very, very,
Seems
very
like the
curious about
question
that.
got shortened, like in your view.
I like that theory. Oh, I
You
gotta
just
call
couldn't be
Google
bothered to
Forms.
type that in.
I like that theory so much better.
So, what is your view?
Honestly, I think you guys probably have a more interesting view than me, but I'll give you 10 seconds of mine on there because I know we covered it a lot in the last one.
Well, we can let. Wait, what is this a real 10 seconds or is it a 10 minutes?
No, I'll actually. Is it Eric 10 seconds? No.
I'm just kidding.
I actually have a very cheeky answer to this.
Well, I'll give you a cheeky answer and let's hear Banks' thoughts on it.
Yeah. Honestly, how does it impact investment sentiment? Depends on the investor. If you like volatility, it's great. If you don't, it sucks. It depends on your perspective.
Mm-hmm. Banks, what do you think?
Yeah, I'll second that, and I think it really depends on what is being said. I guess. I mean, when you're talking about taxation, no one likes taxes going up. When you're talking about public spending, everyone thinks it should go down. When you're talking about investor related news, I think it really just depends on what it is. To be honest with you,
Yeah.
I think it's going to be volatile no matter what in today's market, especially with the way that media and social media is, because I think stuff can get blown out of proportion.
Mm-hmm.
You hear what they want you to hear,
Right.
and like even when news drops, I mean, I don't even know what the news means anymore. To be honest with you, I just know that it drops, and I don't even know what's good or bad on some of the reports. But it is what it is. Like the way that we trade on the futures market, you don't really need to know you need to know the news, but in essence, what brings you to that final number, it's a hit or a miss.
Yeah.
Is the biggest thing.
Right. Is it in line or is it out of line with
Yeah. Or is
expectations?
it like a super miss.
Right.
If it's close, then it's like, well, I guess it was close.
Yeah, close enough. No, most of the time you're just using those reports to go back and look and see what happened. But for the most part, like, and I think you'll probably second this, it just seems like they're used as liquidity events. They're just a chance for
Exactly.
business to get
Yep.
done. Whether they need to sell that day or buy that day is all that matters. Like, we've seen the shitty numbers come out and then the market still goes up.
Right on. I mean, Kyle, you hit such a golden term there. They're just liquidity events.
Mm-hmm.
That's really what it is. It's short term. It's not. I don't know. It's just. I very much agree. It depends on the perspective of the person.
I think an economist somewhere out there just got his wings. Anytime someone says that's short-term noise, an economist gets his wings.
Yes, exactly.
All right. Well, what do we got planned for today? Maybe we should jump into some of this stuff here.
Yeah. So I'm really, as you guys know, I'm way too nerdy and excited for this because my background's labor.
Mm-hmm.
My first love in economics.
I used to work too.
Is there video of this?
Yeah.
Because that was your face when you said that. Your face was amazing. Just a dead fan. I fucking love it. No, so this is a weird one. So like, I think Jesse, I think your question actually sounds nice on this because your question was sentiment, right?
Mm-hmm.
Labor sentiment. Labor is when you see the labor data, that person already has a job or that person already lost the job. Like, labor data is so hard to trade on. Like, hey, we were all pumped when we saw those job numbers late last month. Like,
Mm-hmm.
or I should say the first week of this month. Like, great, but like that guy's already been working for a month. like that dude's already been fired. All right, those unemployment claims are already open. Like, that's what makes data trading hard because in theory you should be able. And there are economists and there are great finance minds who have done this. Pretty accurately predict what the labor number is within a few tenths of a percentage point.
If that's the case, then why are they so often getting revised by like sometimes pretty significant amounts?
Yeah, so revision is a little different. So when it's being revised, it's not necessarily saying the previous number was wrong.
Mm-hmm.
What it's saying is that there was delays in reporting, and they use an estimator for what those delays are going to look like. And those estimators are really bricky. So like great financial analysts who are constantly changing and updating their model, they're more flexible than say the Bureau of Labor Statistics, where the Bureau of Labor Statistics has a preset defined track they have to go down for those over under assumptions. So in the long run, their models have this real strong confidence because their models care more about a wider gap but stronger confidence it's going to be between those two guardrails. Where the guys who are trying to trade on this, they're living and dying by a much narrower margin. Otherwise, they wouldn't be able to trade.
Right.
So the Bureau, I mean, some of the best I have a friend I went to grad school with, and she works there. The Bureau of Labor Statistics has some of the best economists in the world. Like, they are really crazy talented, but they're not in financial economics, so
nobody knows.
You don't really see like their balance sheet go up and down. It's just like these amazing minds just super focused on labor, making Eric really jealous. Yeah, so one of the things I see a lot in trading is people, the job report. You hear that said over and over again. And I sit there going like, 1 month of labor data is useless.
Mm-hmm.
Is absolutely useless. And people, listen, you guys don't do this. I know this. But like, you guys have probably heard stories about people taking pretty major positions based on job reports, especially some like guys who are early and more into trading. Or earlier in their trading careers.
Oh, yeah.
Like, they're trying to play the news.
Yep.
Right? And it's a dangerous game.
Mm-hmm.
It's just a dangerous game.
Yeah, I think even when I first started out, I remember that, like, listening to other people's squawk boxes and being like, oh, it's a miss. Oh, that means sell. Well, hang on. Not necessarily.
Oh, no.
Maybe a miss is good in the long run. Maybe that means that the Fed's plan is working and that they're not going to cut interest rates. Like, you have no idea how these things all interact. And then you also just don't know the intentions behind what people, the big players, are doing during this news event.
Yeah, I think when you have, the Phillips curve, the relation between inflation and unemployment. So I think there's like interesting aspects that investors can really target on here. Where one of the best things about being invested in commodities is that they're hedging against inflation, right? Like, that's one of the best things. Is that if you own an asset and you're dealing with a high inflationary environment, that asset should proportionally inflate with, general CPI.
Mm-hmm.
Now, one of the fun parts about that is that inflation is inherently a volatile. Like, it doesn't care about volatility. Inflation doesn't have that concept built in there.
Mm.
So those underlying assets in a high inflationary environment still will, statistically usually experience more volatility over time frame. Now, it's systematic volatility, so it's not, you still have, idiopathic and you still have firm specific volatility. But as you increase systematic volatility and you increase and your CIP go up, so you have systematic inflation. Both those things affect asset prices. But statistically, inflation has a bigger impact on unemployment. So while you might be seeing this tide rise, and you see these two major factors between your volatility and your inflation, if volatility outpaces inflation, you may see a not as pronounced effect negatively on unemployment. Conversely, if you look at unemployment and it's underperforming relative to your inflationary benchmarks, that's another way to tell that a lot of the growth that you're seeing is more likely based on volatility, which means you got to make sure you have that price right, especially if you're like an option trader
Mm-hmm.
and you're trying to balance out like your put call parities, and you got that sigma, you got that inflationary risk in there, and you may not be able to time the market. I'm sorry, let me rephrase that. It's not that you won't be able to time the market. It's that you may not know which portion of that asset increase is coming from inflation or is coming from volatility. Now, you can use labor data, and if your labor data is relatively static, then it means that the market growth or market change, let's put it that way, is more volatility focused rather than something from inflationary effects. So you can almost use it as a canary.
Hmm.
That's the way I always say, like, that's a more interesting way to combine labor economics and financial economics, which are two fields that rarely ever interact. But I'm going to tell something shocking here. You need finance to make payroll. You just mysterious thing. I do $200 million in payroll a year. I need finance to keep the people employed. So as much as I want to separate those two fields, there is quite a pronounced overlap that can be useful to investors.
So how does that interaction work then? Because I remember that, like, yeah, in combating inflation, like there seemed like they were trying to get unemployment raised or up higher. Like, how is that supposed to help? Does that just mean there's less people making money and putting it into the economy that causes less demand, and then that causes less inflation?
Yeah, no, absolutely. So yeah, you're right on, Kyle. Like that's the policy being used by the Fed. Like, that's a beautiful way to put it. To kind of dive into some of the like underlying architecture there, nobody really wants to drive up unemployment.
I wouldn't.
It's not really
Right.
like a good policy. It's an effect of trying to suppress inflation. Now, I have this thing like my mentor in economics. Somebody always told me was like every statistic is a person. You guys heard me on this right before. You should celebrate a decrease in unemployment. That means somebody found a job. You should celebrate a decrease in poverty. That means people have stability. The more you remember these are real people behind there, the more we're going to try and advocate for better public policy. Now, in this case, I think this is going to sound kind of weird, but when you have an overstimulated economy, firms overhire. It is easier to hire somebody than it is to make a large-scale capital investment.
Mm-hmm.
Both those pieces increase production. Your production function is some combination of labor and capital. So capital is long-term. It's durable goods. It's things that take a long time to ramp up. Or you can hire an individual to do that job, and that's your labor input. Conversely, it's easier to fire somebody
Right.
than it is to hire somebody. So there's this kind of concept that when the market's overheating and you have this really, you have runaway inflation and you have these runaway effects, and inflation is always short run. There's long run inflation's is a thing the Fed will talk about, but inflation's little steps along the way, right?
It's transitory.
Transitory. You heard I don't know if I was on your show when that started coming out, and I was just like, "What? It's always transitory. You just can't." Yeah, of course. Like, thank you, Federal Reserve, for fucking stating the obvious. I just was like, yes, water wet. Congratulations. That's how we.
Right.
Waves are transitory. You could argue that. So, but feel free to try and stop a wave. So there's like this concept that kind of sucks about economics. All right, like economics is it's a dismal science. It makes a lot of people. It's hard to be an economist and not be optimistic, but it always seems to have some sort of sucky effect where it's like you're just telling people something that sucks. When you have that type of inflation and the market's overheating and the labor pool's overheating, and firms are over hiring people because they're trying to take advantage of these short run price increases that you're seeing driven by inflation, and the firm takes on all this extra payroll because it increases production. It's easier than trying going out to the market. And so some federal policymakers, and I'm not even saying this is a bad one, I'm not trying to criticize it, I'm just kind of explaining what it means to somebody who follows financial news,
right?
Is they will say all that extra employment is a threat to the health of the economy as a whole. That too many people on the lifeboat, like the boat's going to sink. And all that extra employment is basically firms making very ill-advised short-run labor investments. And there's a concept, if you there's a couple analysts who are on Bloomberg a lot. So I don't know if you guys have probably run into them. I know some of the listeners may have run into them, who they don't stop talking about the payroll spiral, and they're so right. Where firms will drag themselves down by over hiring, especially software companies, and especially banks, especially places that don't have to match capital labor at some very aggressive rate. Like you can only hire so many forklift operators, right? Like you run out of forklifts. You can't have two guys sitting on each other's laps driving a forklift. That's a HR issue.
Well, that makes sense then. Why, like a place like Intel, like when I worked at the steel industry, the aluminum industry, we lost a lot of talent to go for Intel whenever things were going well and they were like ramping up their hiring. But the thing with Intel was you'd be fired a year later when demand started to dry up, and they were very cyclical with how they hired their employees.
Yeah, you hit the word there, cyclical. Like those are our three types of unemployment: structural, functional, and cyclical. And of those, cyclical is the one that you're trying to stop with inflation. Inflation won't prevent frictional unemployment. Like highly skilled people choose to leave their job sometimes. It just happens. Nothing to do there. And structural is a larger issue about skills. Cyclical can be caused by inflation, and sometimes it's cutting off the arm to save the body. Nobody wants a government policy that takes people out of work.
Right.
That's not what the goal here is. But if it brings down if it causes a massive recession, then it's a tough. I respect policymakers who do make the tough decision that's unpopular.
I don't think I could.
No, I couldn't.
Not something that affects a person. I had a hard time hiring people when like not everybody was sold on it. Like that was something that always blew my mind. A boss would be like, "Oh yeah, we'll give him a shot. If we don't like him, we'll get rid of him in 90 days." No, the guy has a job. Like you can't hire him and then put him out of work if you're not 100% sure you want to take this guy.
Yeah. So Kyle, you're expressing why I love Austrianism. Your decision you just made is a decision that gets made in thousands of firms all across the country. And we combine those together, and the government, the federal policymakers can't sway your viewpoint on that.
No.
They can merely add boundaries to make it easier or harder to make one decision, and that's what they're doing with these policies. Yeah.
Okay.
No, that's a great example. That's a good example, Kyle. I like that. I love the real examples.
All right. What we got any follow-up questions here on this one?
I don't.
All right. Where were we?
Well, I think the other part I wanted to talk about investment strategy related to labor market. And I wrote this on like the little note section because it's my favorite part to talk about is signaling. So like in economics, like we talk about signaling like a lot, like the like signaling is sometimes from an investment standpoint the most beneficial thing about economics is that it helps people go which way are things swaying. Right? I would never recommend investors making I can't recommend any types of investments on CFA, but in terms of broader financial discussion, I would never recommend using labor data because it's so already baked into the market, and those actions have already occurred by the time you see that data. It's a month old. But signaling is interesting, and we see it in layoffs. Layoffs are an exceptionally good signaler, and that sounds like the most no shit, Eric. Of course, layoffs are a signal, but I'm going to raise that ante. I'm not just going to tell you a company having to lay off 60,000 people means the company's in a bad spot. Your listeners are smarter than that.
Right.
They're smarter than me in general. One of the things I have and I have used this myself when looking at stocks like this, the difference in layoffs,
The difference in
right?
layoffs.
Yeah.
What do you
So
mean by that?
firms make different decisions based on where they are. So if a firm is being very is if a once successful, what we call a big pig in economics in an industry is dominating, and they start losing to the little pig or the new nimble guy, the big pig will lay off. They will push out. They will cut jobs, cut costs, cut all this. That doesn't mean that industry is failing. In fact, it means that the little pigs, who usually have a lower value, definitely lower PE ratios and stuff like that, are poised to gain more market share. We should do is look at demand of the market as a whole. Is this industry producing something that everybody wants?
Uh-huh.
And if one guy is too bloated and inefficient, he's firing people. Don't abandon the industry. Maybe it is. Maybe you should abandon the industry. It depends on what everybody else is doing. But looking how firm comparisons, looking at comparison of firms based on how many people they lay off. If one guy's hiring, that means it's probably that's a good way to detect early before it becomes knowledgeable, public absorbed into the public
Right.
knowledge space, that firm may have something different.
So like if say like Nucor starts laying off like a large number of their workforce, but like Cleveland Cliffs and ArcelorMittal and some of the other big names then are actually scooping up talent, then maybe that's a sign that we should be looking at those other companies in favor of the Nucor, the dominate
Yeah,
guy out there.
because exactly, and this plays into something we discussed earlier, which is it's easier to hire.
Yeah.
So the first step these companies are going to take when they're in a position to really start expanding within their market, especially if one guy's losing space, is labor. The fact that labor is so fluid is a great way to kind of detect trends early on. And again, like labor economics and finance really ever touch, but there's a lot of good information that can be shared
Yeah.
between those two.
What about like looking at like just the depth of the pool? Because shouldn't that be something like worth paying attention to? If like a bunch of people are suddenly hitting the markets and it's an in demand like vocation or skill talent that they carry, then maybe that is also a good thing for those other companies that are scooping up talent.
Yeah, absolutely. So another one of the coolest things to look at, and this is something you only have to do like once or twice a year, but look at like the number of degrees that are graduating out.
Mm-hmm.
One of the best indicators is engineering degrees. So like China is producing 50,000 engineers a year. They're 300,000 short of what they need to maintain. Oh, I mean they're in recession right now, but previous to this, what they needed to maintain for their economic growth.
Mm-hmm.
You can whittle that down to specific industries. So like if you're like you're going to invest in MP, you're going to invest in what's that, California precious metal, not precious metal, rare earth metals.
Mm-hmm.
Now, if you see like there's a large amount of chemical engineers that are needed for that mining process, right, and you suddenly see a decline in chemical engineers, well, that can give you two pieces of market investment information. One, you're going to see an increase in labor costs in engineers for this industry, and two, it means that layoffs are less common, but way more of a market
Right.
signaler when they do happen.
Right. Because if there's not that much talent to go and scoop up, then you're going to want to hold on to what you have, even if the times get tough, because the cost to replace them is going to be too much. Longtime fans of the show should be familiar with the lender formerly known as Sue Pullen, and I'm pleased to announce that she's back, fresh off a rebrand and ready to help as Sue Mackey. Sue is a certified mortgage advisor at Fairway Independent Mortgage, an equal housing lender who focuses on finding the right product for you and your needs. She has over 20 years of experience helping thousands of homeowners. Whether it's purchasing, refinancing, or even a reverse mortgage, Sue will help. Sue's licensed in 36 states now, so reach out and let Sue Mackey it happen for you. The best way to reach her is just give her a call at 520-977-7904 or in an email, spullen@fairwaymc.com. Fairway Independent Mortgage has an MLS number of 2289. Sue Mackey has an MLS number of 206048. That email again, spullen@fairwaymc.com. And that phone number is 520-977-7904. Shoot Sue an email and let her know she needs to update that address.
Yeah, and kind of like in a really broad market one. So we have something called the ISLM model. It's what the backbone of macroeconomics, and it basically looks at investment and savings, and it looks at your labor market, labor demand, labor supply, as a way to express where the long-run aggregate supply or GDP is going to go. And I always love that beautiful relationship. that both investment and savings, which is your solo growth model, which is your investors that you guys so great talk about, and whether we like to talk about it or not, but they're married to the labor market. There is no one without the other. Like, in labor often gets talked about as kind of the secondary impact, but the people designing these computer programs, I think Bear, who was on when we were on a few times ago, he talked great about that. It was so interesting, him talking about the different processes and stuff.
Mm-hmm.
Somebody's designing that, and that's a talent that's needed. The reason China can't invade Taiwan and use the Dutch machine to make advanced semiconductors is they don't have the talent to do that.
Right.
Yeah.
Yeah, and I know I'm wicked biased towards labor. I just am, but it's not labor or finance. It's not labor or institutional. Like, labor is just insidious stuff. I tell other economists who work in like finance and stuff, I'm like, you are a labor economist. You're a laborer working in economics. You're part of this. You're part of this team, man. You may not like it, but you're here.
So, just a follow-up question is so, like, when they talk about like the jobs, like unemployment and stuff like that, can they break that down per sector?
Yep.
Your view.
So
Your
I just love that they include it. Yeah, so the Federal Reserve will actually break it down by cluster.
Okay.
Now, I do want to make a couple. If it's cool with you guys, I would definitely make a software recommendation for anybody who's like wants to work this into their portfolio.
Not advice. No, I'm just kidding. Yeah, go ahead. That's fine.
So there's a company called Social Explorer. I think like every Fortune 500 company uses them, and they're run by Oxford Press. It's a little bit. It has a little bit of a hefty price tag. I think it's like maybe $1,000 or $2,000 a year. I think they have much cheaper plans, but they have both geospatially. They have it, and they also have macro data for every single discipline and degree you could possibly imagine. One of the coolest ways I've ever seen it used is people will go to like Silicon Valley and they'll look up either primary degrees. So look at like how many computer scientists are out there and track that over time. And you can actually, again, I haven't done it personally, but I've read papers of people correlating the number of like computer scientists living within like the census blocks expanding out from Silicon Valley and tracking it with earnings. And then overlaying unemployment and basically using lag effects, able to predict the next 3 months of share price based on unemployment data.
That's wild.
Yeah, it's wild. I mean, again, anybody who wants to do that, like, it's serious modeling. But if you're like a day trader, or like I would call like even a semi-active trader, man, it is impressive. These guys hit like it's a lot of data, but it's when you have it in the right spot. But applying that geographic side of it.
What was the name of that again?
Socialexplorer.com.
Social Explorer. Yeah.
Yeah, I'll post it in the chat. Maybe we should try to get a demo set up with these guys.
They're wicked nice guys. They're all super British too. Like, they're wicked funny.
Do they talk about, or are they the ones doing this, or is it just their data that people are using?
No, it's their data. So
Okay.
they're Oxford University. So they're kind of cool though. Like, I've had to call them with like data continuity questions, and they'll straight up connect you with like some guy who's like 10 times smarter than me, and just like get a straight. Like, I remember I called them. I remember I texted them one time, or sent them like a service request, and I was doing this geospatial data analysis for home prices in the Boston metropolitan area, and I couldn't figure. There was just a gap in the data. Like, I was running the model, it just every time I got this discontinuity. I'm sitting there like, what the, like, I've done geospatial RDDs. They're fun to do, but this is what I was doing. So I just like emailed the guy, and I was like, hey, I'm having this problem. And the guy calls me up, and we have a nice conversation. And he's like, oh, like, we're talking about like the R code that I'm using. And this dude's like, oh, I have that crayon on my computer. Let me check that out. It ended up being my fault. Basically, what I was doing is I was using these bands around the city, around Boston, to kind of express like a Muth Mills model. And I had one town that I had put in both.
No.
So when the model was running, the model was like, your prices just went sideways. Like, literally did. The guy was so polite to me. I'd be like, you idiot.
He must be from England.
Yeah. So yeah, that's a great way to do that, because even though we have remote work, and remote work confuses this modeling a little bit, don't get me wrong.
Yeah.
Data is, when it comes to the data on unemployment, it's still very local. It's very local.
Wow. Huh. Well, you're giving me some ideas of something to play with.
If I could talk about something a little macabre for a second.
Oh, okay.
So sometimes, like what you'll see after, like what happened with Boeing,
Mm-hmm.
is like sometimes you'll see like an increase in certain engineers in a geographic region
Right.
as they surge up to address the stuff like the catastrophic accidents with like big news events. You can actually look at some of that data and actually see like data pull that comes in there. Um, so if you want to know, like, you got to adjust your data for that. Like, oh, it's not like suddenly Boeing's hiring a bunch of engineers because they're gonna announce the 797. It's like they got to figure out how to make sure that door doesn't fall off a second time.
Oh, poor Boeing.
Yeah,
Hey, at least they got Baltimore to keep them out of the news.
yeah, right. Oh god.
Sorry about
That's
that.
too soon.
Yeah, it probably was. All right, let's see here. What else do we have on this? So you promised us employment trends and wage analysis. We kind of talked a bit about the labor economics, but not a whole lot about wage analysis. That's something I'm kind of interested in.
Yeah. So if you've anytime I do a keynote, I always like doing a section. Or anytime I speak, I like to do a section on like wage analysis. Like, what does wage mean? Like, that's always like a weird discussion because everybody has an opinion on wage, but
Mm-hmm.
wage is one of the most complicated things in economics. Like,
How's that? Like, what defines it, or just the concept as a whole?
yeah, like concept, like who decides how much somebody should get paid?
Oh, the market does.
Yeah, the market.
Yeah.
So it's marginal product of labor times price level.
Mhm.
You can't change the price level, but what is marginal production of labor? I can give you the calculus answer, which is partial derivative of the labor function, where the labor input is driven to its first derivative. That's a useless fucking answer unless you spent 6 years studying economics and
I recognize
don't
some of those words.
Yeah, I literally feel like what I just said is gibberish. It's where supply and demand of the labor market meet.
Mhm.
That's the marginal production of labor.
Right.
Just adding one more person, how productive they are. No, Kyle, it's just you're 100% right. It's market demand.
Well, but I mean, one thing that annoys me is when people are getting up there yelling at others for getting wage increases because calling them like the reason for inflation. Like, you know what? Like, I don't know. The individual person has the right to go seek out the highest price they can get for their skills.
Yeah,
You know, that's
absolutely.
my feelings on that.
Yeah,
Shocking.
The company that's paying them,
Yeah, has the right to decide that.
yeah, and the company that's paying them also lost that buying power. The company isn't creating new buying power. There's no new buying power in the economy. It's not like I've heard that argument before. I'm like, no. So that company had $100, but somebody was like, you need to pay me $10 more. So that person has $10 more in buying power, and the company now has $10 less.
Mm-hmm.
Where did inflation come into that equation?
Yeah, that's a good point. There's no money being made. It's not being manufactured anywhere. It's just changing hands.
No,
That's an excellent point.
I've asked people that question. They're like, well, that person's going to spend money now. I'm like, and the company was going to
Hoard it, probably,
Yeah,
right?
I'm
Yeah.
like, or pay out its shareholders, or buy more goods for production. I don't. Like, if your way to stop inflation is like just make people earn less money, it's like, by that logic, let's just go back to bartering. That will stop inflation.
Right. But well, I mean, it is kind of a tricky conversation when you think about like the minimum wage conversation and like whether or not that should be significantly higher. And I'm kind of for that. Like, minimum wage hasn't changed much since I was making minimum wage. Like, that's kind of a problem, right? But
I don't know, man. So I'm going to tell you a dirty secret of labor economics.
Yeah?
We don't talk about minimum wage.
No, you don't.
No,
Why not?
It's
Is it forbidden?
It's a political thing.
Is it?
Yeah, it's more political.
Yeah.
So few people in the economy make minimum wage.
Mm-hmm.
So that's minimum wage is called a price floor in economics. That it's called a non-binding price floor, meaning that so few people make it that changing it up or down doesn't have any real effect on the economy.
Are you serious?
Yeah.
What percentage are we talking about here? Like, of like the entire workforce?
It's like 2%.
Why are we so
Last time I
focused on it?
checked.
Well, I guess 2% is still a lot of people when you're thinking of 2% of a million or 100 million.
Because it's a headline, though. I mean, when you think about it, I mean, look at all the big box stores, Target, Walmart. I mean, our minimum wage here, I'll be honest, I don't even know what the Missouri minimum wage is, but I know it's not what they're making because they're all making
More.
18, 19, 20 bucks an hour.
Right.
Now, if they talk about raising that to 15, their pay is not going to change.
That's the thing that I never understood about that is like you can throw a whole lot of things. Like if you could make the same amount of money flipping burgers, like who's going to want to come push a broom in a fucking steel mill? If you could,
Yeah.
if you get significantly less stress and less likely to get murdered by a fryer than by a rogue, piece of hot metal flying around.
Yeah, I mean, and I just looked it up. I mean, it's $12 in Missouri, and I know because I guess right across the street from where I work at Target, they're hiring for 18 to 21 at
Mm-hmm.
starting pay,
Man.
and that's hard to compete with because when you're talking about like what we look for, like at the bank, when we talk about like our retail staff,
Mm-hmm.
we're paying the same people that are handling money have access to a vault, the same as someone who is at Target. In comparison, because
Right.
like when you're talking about someone who's starting and has no experience, it's pretty much the same pay pretty much everywhere.
Right. Right.
It's just a matter of what you're willing to, that. And now there's perks. With us, you get probably better health insurance, 401k, all that kind of stuff. But again, I mean, it all starts at the same basis,
Yeah.
and it's not minimum wage most likely.
That is funny though. Speaking of wages, that's something that's not typically considered is all the other benefits that go into your like compensation package. That was something one company I used to work for would send out to us like, here's how much money you're really making, which was
Oh.
kind of like annoying, like fuck
Ooh.
you. Like but at the same time it is still kind of neat to see all the stuff that you like the value of everything else you're getting. Yeah, they'd send out a little statement that said like, oh, with what we pay in for your social security payroll taxes for their side of the insurance that you get, the 401k match, and then all that other they put all that stuff in a line item to show how much money you're making.
You're not gonna. You have to pay Social Security. It's the law. That's how you be nice.
I know. That's kind of how they spun it, which is kind of ridiculous. But
We haven't beaten you today with this lead pipe.
but I mean, it does go to show that there's a lot more that goes into your wage rather than just the actual dollar amount you're getting.
Yeah, so I fact checked myself
Mhm.
because I want to make sure that 2% number I said was right. So 2.9% of workers 16 to 24 make minimum wage, 1.1% 25 to 34, and less than 1% make over 35 make minimum wage.
Mm. And most of those are probably retirees greeting you at Walmart.
Yeah, so like the problem with minimum wage is you can increase wage. Wage is marginal production of labor times price level.
Mm-hmm.
You have to increase one of those. So you hand somebody more money. The W goes up. Which variable goes up? Do people become more productive when you give them more money? Or does inflation occur? What's more likely?
I would think probably not the productivity one.
Yeah. So that's what happens. That's what most data shows. But then on top of it, you have this weird effect where people end up earning less hours. So their gross monthly income drops because the firms that pay minimum wage are exceptionally price sensitive.
Mm-hmm.
And people who earn minimum wage tend to not have skills that are inelastically demand. Oh wow, that homework question came
All
back.
right.
That bastard. Oh my god. Damn it! I'm gonna respond to that.
I know,
kid.
right?
I'm gonna. But
Send
that
him a Chat GPT answer.
I will. Oh my god. Yeah. Oh wow, that's awesome. So those firms demand less hours because they're more inelastic. I'm sorry, they have more elastic demand, so they demand less hours, and now you're talking about less overall take-home pay.
Mm-hmm.
I've, from a research side, my position's always been increase productivity, which means reduce or eliminate the cost for skills training. In Massachusetts, we adopted free community college after the age of 25. I think that's wonderful.
Yeah.
I think trade schools increase that marginal product of labor. Let the economy drive up the wage. Make welders, make plumbers. Give kids a second chance to get back into college. Like, do that. Don't just increase the price level. That screws us all. And who's the only people who benefit when price level goes up? People with assets.
Right.
Who doesn't have assets?
Minimum
The
wage,
person
yeah.
making minimum wage. You're just making that person's eggs cost more money. You're not making them any wealthier.
Oh, that's an excellent point.
I've often said I wish minimum wage was a solution. It would be a lot simpler.
Yeah, and I think that's probably one of the biggest things that we hear just in the banking industry is more of the service based roles. For most of the clients that I have, is you just don't have that trade school mentality anymore to where
Mhm.
people go that route. And there's a lot of businesses that we have that are contractors, plumbers, etc. And they just, I don't know, they can't find people to work in that industry, and
Can't find
it's such a
electricians,
hard
can't find
thing.
mechanics.
Oh, right.
Yeah, and it's such a hard thing, and in today's world, there's such a need that the wages have skyrocketed
Yeah.
in those industries.
I get a job tomorrow in the steel industry if I wanted to go back
Right.
and be an electrician again.
One of my favorite, I had a really cool moment. I'm getting old, so like I'm having more reflective moments in my life, which is horrible for me because I'm not a serious enough person. So Quincy has an area that has a lot of like Section 8 housing. It's actually a really nice area. And I used to teach financial literacy at the local. It was a YMCA that didn't have a gym or anything, but it had like after school programs, had a food pantry.
You're my hero.
Had this
I
awesome,
love that.
like had this awesome program where they would have like clothes for people going on interviews and stuff. It was, dude, freaking those people who work there were saints. Like they like. So I taught this class called Youth and Government and Financial Literacy. It's called Teen Success. I was pumped because I had my kids who were all on scholarship go to the Youth and Government Conference,
Mhm.
and two of them made committee, which is like the hardest thing to do. That means they wrote a bill good enough that it survived review and everything.
Oh, no shit.
And we did better than the kids from like the affluent areas. I was like, because I'm I do think I do a lot of cheerleading.
How can I reach
I love
these
hyping people up.
kids?
How can I reach these kids? So I would teach this financial literacy course, and it was fun, man. I'd like get paychecks and break up what FICA is, work with all these kids. I remember one time I was teaching for 2 weeks about how money is just the U.S. dollar is backed by basically a note from the Federal Reserve and vice versa, but that's not a bad thing. Don't fall into reading shit on at the time Twitter and
Right.
Facebook from people who can't pass freaking high school trig who are trying to tell you how the Federal Reserve works. Like it's good that money is fiat. That's a good thing. Let me tell you what happened to the Spaniards when they landed in fucking Mexico. You know what happened? All their currency inflated. Currency inflates. If land can inflate in value, anything can inflate because there's literally not any more new land.
Huh.
All right. So I was explaining that to him. So I remember we did this thing where we were simulating stock markets based on dice rolls, and I gave them all fake money, and I said, "What?" I go, "Just like the U.S. dollar. What is this backed by?" And they were like, "Is it like another piece of paper that says like debt?" I go, "Yes." And what's this debt backed by? And they said like this like fake money, and I was like, "No, real U.S. dollars." I went and got $101 bills. By the way, don't ever go to a bank and ask for $101 bills. It's a horrible experience, especially being a man.
It's not that bad.
It wasn't pennies.
Like that. And they played with real money, and I got the best quote ever from a kid. All right, I'm sitting there, and we were talking about markets, and I would always really hammer economics with them. And I was talking about how to prepare for build a resilient financial base. And I said, if you found out that there was going to be a milk shortage, what would you do? And some kids said, I don't like milk, so I don't give a crap. Some other kids, I go to the store and buy a bunch of milk and freeze it. One kid goes, I'd buy a cow.
Yeah.
Like, you could be a millionaire. I could be a millionaire. Let me give you money. I want you to invest for me.
How old is this kid?
That kid was like 16 at the time.
Oh.
He's graduating college soon, so I gotta invest in whatever he wants to do.
Oh yeah, he's the one who wrote you the question.
I mean, if he was, I'd be amazed. Like, I would. No, but I'm in CVS a few weeks ago, and one of these kids comes up to me, and he goes, "Hey, like, I'm lanky dude, so people kind of notice me." And I'm walking in, and this kid says to me, he's like, "Hey, do you recognize me?" I was like, "Yeah." I won't say the kid's name, but I was like, "Yeah, oh, absolutely. He's one of my best students. I love this kid." He starts telling me, he's like, "Hey, you always said to us about like, you got to build skills. Skills are what helps you. Build up the toolbox." I always use that frame, build up the toolbox. And he goes, "So I became an electrician, and I saved up my money." He goes, "I got a good scholarship to go to trade school, saved up my money." He goes, "I bought a house. I started, you told me like, you were the first person to talk to me about like investing, what that can do." He's like, "I'm getting ready to he's like, I'm getting married and I did all this stuff." And he's like, "Yeah, I got a trade and I paid attention to my finances. And now I have like all this stuff." I'm like, "Dude, yeah, it's not that hard. It's not that hard." And I was like, "Yeah," so I'm so amped up. Like, yes.
Ah, man. Why don't more people do that? I love that idea of like going and teaching kids financial literacy. That needs to be curriculum, like mandatory.
Yeah. It should be. It's when we recently changed our banks at the city. So we did an RFP. You don't have to do one by law, but I'm always like, dude, do an RFP. There's so many banks. It's weird to just pick a new bank. So we have anywhere from like $80 to $150 million in liquidity at any given point. So it's good holdings. Like even the bigger banks are like, hey, no, we'll do business with you. But one of the things we required in the RFP was like, you need to do financial literacy. You have financial literacy planning. So our main, we selected 4 banks, and one of the banks we selected, they do like not just, hey, we go to school and hand out pins and talk about financial literacy, like straight up coursework. Like they go straight up. Like
that's awesome.
Yeah, the guy who runs the program's pissed. He's like one of my favorite people. But yeah, that was a huge thing for the city when we did this. They were like, we want them to have a program in place. We want them to teach, bring these resources.
Oh, can you get us some of their quizzes?
We should do one of the quizzes on the show.
That's what I'm thinking. Yeah, that might be a fun thing to do on one of these episodes.
I will email Grant tomorrow morning and be like, yo, Grant, can you give me... He's one of the funniest people I've ever met in my life. He does all the CRA for this bank, the Community Reinvestment Act stuff.
Yeah.
He's like, I have the best job in the world. Like, he's like, my job's just like take bank money and like invest in areas. He's like, it's a blast. I don't need to worry about anything else. I'm just making sure the feds are happy with the money we're putting in here.
Oh, I fucking love that idea.
Yeah, that's funny because I'm actually doing a class tomorrow.
Are you teaching one or are you taking one?
Yeah, no, I teach one on a quarterly basis, and then I'm actually on a panel tomorrow for business entrepreneurs.
Yeah, didn't you just recently do one like a couple weeks ago too?
Yeah, so the one I'm doing tomorrow is a new one for this year, but I'm on the board of one that we do like a grant basically.
Mm-hmm.
We do like a grant for it, and it's if they go through it, do the business plan and everything, that they're able to apply for this. It's up to $5,000 that goes through this organization. So it's for new business startups, for marketing and that kind of stuff. But they have to put in the work to get to that point.
So
they got to put in the business plan, get registered. Anyone who goes to the class.
What time is it?
I'll hit you up off my.
Could use a fresh injection of some capital.
How close are you to Missouri?
Yeah, not that far.
So it is a loan.
Oh,
so they pay it.
That's bullshit.
But they pay it back. But it's really like the first time that they've ever had anything to like financial responsibility on paying it back.
Yeah,
and you know what the funny thing is, this is just a funny stat, but of all the loans that we've given. I want to say like 90% of the women pay it back completely, and we've had less. It's like less than 25 of the men pay it back.
My wife is more responsible than me. That I will agree with that.
Exactly.
I think that it almost seems like that changes with age. Like the younger they are, the more likely the women are to be responsible. It seems like.
I can see that. I'll tell you. So my wife's never filed taxes because. She's every time, so she's got her first like formal employment, like full time stuff after we started dating. So I just always filed my wife's taxes. Mm-hmm. She just like it's just something so part of her life that doesn't exist, and I'm like,
I don't think I've
I can see that
ever done my own taxes actually. Now I think about it. Well, he's either hired someone to do it, or my wife is the one who does them now.
Okay, but you at one point were like, oh, I need to think about my taxes.
Yeah, I send the stuff to the person who writes it up, and then.
See, my wife's way smarter than me.
Yeah, mine too.
Way smarter.
When it comes to that stuff, yeah.
Oh no, she's just smarter than me about literally everything. Like I always say to my wife, but the difference is my wife's just a reserved person, and I'm just outlandish. Mm-hmm. I always say to her, I'm like, "Do you want me to like show you this stuff?" And she's like, "No." I mean, like, she's like, "If you don't do it, I'll just hire somebody to do it." And I'm like, "That I love capitalism." She's like, "No, just hire somebody." Why would I'm a measure of convenience.
Yes,
I'm not a requirement.
What's my time worth?
Yeah, no, that's honestly. She's like, I'll just hire somebody. I'm like, oh, okay. Go back to my office and do my do our taxes.
All right, we're getting kind of close to the end here. Do we have anything we want to sum up here? Any other points we want to hit? Any other questions we want to ask before we wrap up?
No, not from my standpoint. My biggest thing that I wanted to talk about, which we kind of hit on, was the minimum wage piece, just because I think it's such a overblown topic. And it's so funny when you think about it, because that's all that's on the news, especially during like political campaigns.
Yeah.
But there's so much more in like the wage aspect of it that needs to be talked about that never gets hit on in those political, campaigns and all that kind of stuff. But it's just an interesting piece.
Like,
Yeah.
I always wonder how they do they go through and actually separate out not just look at an average, but actually take the means, so that, or throw out the high and the lows of the salary ranges to see what the actual medians are of certain industries.
Oh yeah, so the Bureau of Labor Statistics, they have this OWS occupation, like OESW sometimes it's called, but it's basically occupational employment
Mm-hmm.
wage statistics. And you can get percentiles. You can get it by geography. You can get it by state, county, MSA, all that level. Like the data is super available on it, and they do everything. They do 10th, 25th, 50th, 75th, 75th, and 90th percentile for all industries. I use the data all the time. I also serve as the chief financial advisor for our city college,
Mm-hmm.
and I was on the board of I was talking to the board maybe a month ago, and we were talking about dental hygienists, and you can pull labor quotient data and stuff, and I'm like, there's just not enough labor. There's not enough dental hygienists in our metropolitan statistical area.
Yeah.
And I showed the wages and stuff, and it's it's right there. No, minimum wage. Two things I've been yelled at. I've been cursed at and called bad names about. One, trickle down economics, and two is minimum wage. Both by opposite ends of the spectrum.
By both sides.
Yeah, no, right. A lot of I don't want to call them conservative because it's further than conservative. Have yelled at me about trickle down economics, that it works, and I'm an idiot. And I was told one time, yelled at by a janitor, that after I graduate econ school, I should have to go to common sense school because I don't know what I'm talking about when it comes to economics. Oh, can you please leave my office?
Take the trash out while you're there.
Yeah, I was oh, thank you, sir, for yelling at me for 25 minutes.
What a weird society we've morphed into.
It was strange. So everybody over the age of 65 thinks they get a PhD in economics. That's one thing I've learned. Everybody is like, oh, I know about economics. I'm like, do you know calculus? No. Okay, well then, what is a p-value? No. Okay, you're not equipped to discuss this. You lived through a lot of presidential cycles. Congratulations. That's not a PhD. It's not a master's degree. It's not a bachelor's degree. So I've been yelled at for that. I've been yelled at, and then the other thing I got yelled at is I talk about minimum wage, and people think I'm arguing against poor people. I'm like, no, I'm trying to help them. You want an easy solution that you can pat yourself on the back and feel good tomorrow about.
Right.
Trades, production. They have to be able to produce more.
Yeah.
All right. And they will live better lives, and everybody will be happier. If you could magically give somebody a new number on a paycheck, that's going to have some short-run effects. But modern day, with such a reduction in menu costs, and with the velocity of money being so fast, it's fleeting,
Mm-hmm.
even if I'm minimum wage. But isn't it weird? How many people, I've asked people that question. How many people earn minimum wage in the United States? 30, 40, 50%.
No.
The U.S. is pretty wealthy. It ain't that. And it sucks because those are the people who get left behind, and we should have better public policy directed towards them. But it becomes, Mr. Banks said it perfectly, it's a political issue.
Yeah.
There aren't labor economists discussing this, because to labor economists, we're all on the same page. Yeah, you got to increase productivity, man. Oh no, we just need to increase the number. It's that's just not going to help anybody, but okay.
Part of the problem too is like what you guys are saying, that some of the focus needs to be on trade schools too. There's other opportunities out there to gain a skill. It doesn't have to be college. You don't have to go into crippling debt.
Yeah, right. I remember I was getting yelled at about this one time, and I wrote on my whiteboard, I did W equals MPL, marginal product of labor, times, and I wrote P for price level.
Mm-hmm.
And I said, okay, you want to increase the minimum wage? They go, yeah. So I drew an arrow besides the W pointing up. And I said, you have to move one of these up.
Right.
And they did it beside MPL. And I go, okay, so I go, how do you increase that? They go, I don't know. And I go, increase their productivity, so skills training. They go, no. And they erased it. And I was like,
no, we don't want to give them skills. We just want to give them money.
I'm like, they just wanted a short-term solution. So
Right.
I was like, I went over to the P and I made a little arrow, and I was like, all right, so increase this one. They go, okay. And that's inflation, which is going to erode everybody else's stuff, including this individual person. I wish that was the answer.
Yeah.
I'm not sitting here saying, oh, I hate that that's the answer. No, that'd be great. Make my life easier. I was like, minimum wage, increase it. It'd be great.
Yeah, what a bombshell to end on.
Yeah, God damn it.
All right. Well, I do think that's probably going to do it. Thank everyone for joining us tonight. Special thank you to Eric Mason here for explaining to us how minimum wage is actually a straw man argument. You can check out the informaleconomist.com if you want to see more of Eric's rants, or if you want to just message him and congratulate him on his new position. If you have any questions about what was covered today, or if you have any upcoming test questions you need help studying on, email them or DM them to us. Be sure to answer them in the next installment. Just drop the question number on there if you're stealing it from your homework. We'll be back soon with another exciting episode, but till then, pump that 5-star rating like it's NFP and have a great day. This podcast is intended for informational and educational purposes only. It does not constitute financial or investment advice and should not be construed as such. The hosts, guests, and contributors of this podcast are not licensed financial advisors, brokers, or professionals. Any trading or investment decisions made based on the content of this podcast are solely at the listener's discretion and risk. Trading and investing in financial markets carry inherent risks, and past performance is not indicative of future results. Listeners should conduct their own research and seek advice from qualified financial professionals before making any financial decisions. The views, opinions, and information shared in this podcast are those of the individual contributors and do not necessarily reflect the views or policies of the podcast creators or associated organizations. Produced by China Shop Productions.